China's exporters are dumping dollars, the White House is threatening embargoes, and Amazon just got accused of pushing Chinese propaganda for showing price hikes. This isn't diplomacy, it's economic warfare. And Scott Bessent? He just issued an ultimatum that could blow a $25 trillion economy off balance. So ask yourself, what happens when the world's largest consumer market goes to war with its biggest supplier, and both sides think they'll win? Scott Bessent didn't flinch. On live TV, he issued what amounted to an ultimatum. China must de-escalate first, or the U.S. will escalate further. But that confidence may be built on a misread foundation. Bessent argues that China depends on U.S. demand because it exports 5 times more to America than it imports. That's statistically true, but contextually incomplete. According to China's Ministry of Commerce, exports to the U.S. made up just 2.5% of China's GDP in 2023, down from 3.5% in 2018, showing that Beijing's exposure is shrinking. In contrast, the U.S. remains heavily reliant on Chinese manufacturing across critical sectors. And if Bessent is wrong about who has leverage, the entire trade strategy could implode under its own assumptions. But that's not the only fault line. Scheduled cargo volume from China is collapsing. Hapag-Lloyd, one of the world's top container shippers, confirmed that 30% of bookings have been canceled, and projections for May show shipments could halt entirely. According to the Port of Los Angeles, China currently accounts for 45% of its inbound traffic, meaning nearly half its volume is now at risk. This isn't a temporary bottleneck, it's a systemic choke. When shelves go empty, demand doesn't wait. It spills into inflation. With fewer goods competing for consumer dollars, prices don't just rise, they surge. And if you're wondering how close we are to that point, look at what's already happening in electronics, tools, and apparel. Inventories are tightening, and restock delays are stretching from weeks to quarters. So what happens next if U.S. supply chains can't bridge the gap? The 245% tariff slapped on Chinese goods wasn't just high, it was prohibitive. Retailers didn't try to absorb the cost. They canceled the order. According to Reuters, major importers across home goods, hardware, and consumer electronics have halted shipments rather than pay a threefold increase at customs. Bessent claims U.S. retailers had pre-ordered, but pre-ordering doesn't dodge tariffs. They're charged upon entry, not purchase. And there's no workaround. Unless companies resort to smuggling, which is both illegal and implausible, the only logical move is to walk away. That's exactly what's happening. Industry analysts from Bloomberg now project a 32% contraction in Chinese origin imports by end of Q2. This isn't about resilience. It's about what happens when cost structure becomes unsustainable. But here's where the illusion really cracks. Elasticity doesn't mean recovery, it means delay. U.S. manufacturers can't flip a switch and replace Chinese suppliers overnight. Even with Vietnam ramping up production, transport costs from Saigon have risen 15% month over month, and tariffs on Vietnamese imports are currently 10%, with a scheduled increase to nearly 50% once the 90-day tariff pause expires. Substitution isn't solving the crisis, it's inflating it. JP Morgan analysts estimate that supply substitution strategies are now 20% more expensive on average than pre-tariff Chinese imports. In practice, that means higher shelf prices, lower margins, and deeper strain on consumer budgets. Meanwhile, U.S. manufacturers still depend on Chinese components for pharmaceuticals and auto parts. If there's slack in the system, it hasn't shown up yet. So what's Bessent really counting on? Bessent's logic rests on a controversial economic claim. Deficit countries win trade wars because they import more. They need us more than we need them, he stated. But historical precedent complicates that view. During the 1980s U.S.-Japan trade standoff, Japan, despite a trade surplus, weathered the escalation longer due to tighter capital controls and diversified markets. Today, China has built a parallel strategy. Its Belt and Road trade corridors and yuan-denominated oil contracts have reduced its exposure to U.S. disruptions. By contrast, the U.S. consumer is highly exposed to foreign volatility. A 2024 study by the Peterson Institute for International Economics found that U.S. households bear 92% of the cost of tariffs via higher prices, while foreign firms adjust pricing only marginally. So if Besant is wrong about China's breaking point, is he also misjudging America's? The numbers paint a clear direction. In 2018, China's exports to the U.S. totaled $478 billion, accounting for 3.5% of its economy. By 2023, that fell to $420 billion, or 2.9% of GDP. Current year projections show another drop, with bilateral trade volume expected to contract another 12% by year-end. That's not collapse, it's insulation. Meanwhile, China has increased exports to Southeast Asia and the Middle East by 22% in the same period, according to customs data. The dependency argument loses force when the pivot has already begun. The danger now isn't that China collapses, but that it adapts faster than the U.S. can react. And if so, the consequences will land stateside first. But just how bad could that fallout get? When Besant hinted at using his escalation ladder, he framed it as a last resort. But the implication was clear. The United States is considering embargoes on specific Chinese goods, possibly including aviation parts and tech components. If enacted, these moves could trigger retaliatory bans and paralyze sectors that rely on bilateral flows. According to the National Association of Manufacturers, over 37% of U.S. firms depend on Chinese-sourced inputs for core production. Blocking those goods wouldn't weaken China, it would stall U.S. production lines. And, Wall Street is noticing. Goldman Sachs warned that aggressive embargo strategies could shave 0.9% off U.S. GDP growth if enacted in the third quarter. But this isn't just a forecast, it's a fuse. And one economic signal suggests the explosion may already be underway. The Atlanta Fed's final estimate for first quarter GDP stands at negative 2.5%, marking a sharp reversal from the 1.6% growth in the fourth quarter of 2024. That figure, if confirmed, would place the United States halfway into a technical recession. Analysts at Bloomberg Economics cite weakening consumer demand, tariff-driven price hikes, and shrinking business inventories as primary contributors. The trade war is no longer a geopolitical headline. It's a measurable drag on economic output. And with $514 billion in new federal borrowing planned this quarter, per Treasury Department data, fiscal room to maneuver is vanishing. Markets are already reacting. The 10-year yield spiked to 4.52%, while mortgage rates hit 7.1%, choking credit-sensitive sectors like housing. The U.S. economy isn't on the brink. It's tipping. But what happens if Besant pushes one step further? The exodus from the U.S. dollar isn't being led by governments. It's coming from Chinese exporters who no longer see holding greenbacks as rational. As the yuan strengthens and the dollar loses ground, companies earning in U.S. dollars are accelerating conversions to renminbi to preserve value. According to Bloomberg FX data, the dollar has fallen 5.7% against the yuan since late March, despite Beijing's efforts to weaken its currency. That trend creates a clear economic incentive. Hold dollars too long and you lose money on conversion. This isn't retaliation, it's risk management. Exporters are watching the dollar's purchasing power erode in real time and choosing to cut exposure before the decline deepens. But that currency rotation is now feeding a larger instability.